Hi, welcome to Financial ChitChat. I am your host, Jerry Hill. And today I want to address the first-time investor or the young investor. Oftentimes, even this week, just a couple days ago, I was approached by a younger man asking, what should I be investing in? He had never invested in anything. He had just signed on for his first job. And so he was very curious as to what to do. And what I told him is what I'm going to tell you. The best thing to do when you haven't invested anything at all is to first invest in a savings account. Most people have checking accounts, but some people simply don't have savings accounts. And when you're young, I think the best thing to do is to open up a savings account and then put in there your first 6 months of salary. So figure out what your salary is, start a savings account, and when you reach 6 months of your salary in that savings account, I think you'll be good then to go into the stock market. The reason I say that is because we all get into financial jams at times. Whether it's a loss of a job, whether it's a prolonged sickness where you're not getting paid, it's oftentimes a financial hardship on people to cover those costs. So we want to start out with a cash account or a savings account that will cover us in the time during financial hardship or uncertainty comes up financially. Maybe a car breaks down or a washing machine breaks, something like that. But then when it comes down to investing, what I like to tell first-time investors or young investors is pick a S&P 500 fund. S&P is Standard & Poor's. 500 equals the amount of companies that are in the Standard & Poor's 500. Those are top name companies like Apple, Tesla, Microsoft, Nvidia, Amazon. You know, we all use Amazon. Everybody's heard of them. And what happens in a mutual fund is a mutual fund takes those 500 companies and they buy stock in all of them. And so when you buy one share of an S&P 500 fund is a mutual fund, then what happens is you own all of those companies because your shares of that mutual fund equate to a portion of each one of those companies. So where do you get that? Where do you buy that? And the best place to do that is just simply go online. For investing, I use Vanguard. They're a big company, a multi-billion-dollar company, and you can choose the fund. You set up your account online, then you choose your fund, in this case, an S&P 500 fund. Now, Vanguard has a little bit higher of a minimum investment. I'm not sure what it is because this isn't a commercial for Vanguard. I'm simply trying to give you options. And so if you don't have a lot of money right away, then go to a investment company like Robinhood. And Robinhood also will have an S&P 500 fund. And you set that up again online. You give them your name, your address, your social security number, date of birth, all that stuff to establish your account. And then you start investing in that particular fund. Now, the best way to do this is what stock people and investment people call dollar cost averaging. And what that means is allow them to pull out of your checking account on a monthly basis or a weekly basis or however you decide a certain amount of money that you can afford to invest. And as you do that over time, what dollar cost averaging does is it allows you to buy when the market's high and when the market's low. And so your average investment is going to be better than if you put everything into that pot when the market was high. Since you're young or maybe you're a first-time investor, that's really important because you want to buy when the market's low, but you also, are going to continue to invest even when the market's high. And then over time, on average, you will do really, really well. Now, when you ask the question, hey, how risky is the S&P 500? The answer is it's pretty moderate when it comes to an investment. Over the last 10 years, the S&P 500 has returned a 13% return on someone's money. Now, keep in mind that last 10 years includes 2 to 3 years of COVID, depending on how you add that up. So an S&P 500 is a great way to go after you've invested your cash in a savings account for that 6 months of salary. Well, I hope you have enjoyed this, and if you've enjoyed it, please like it and follow me at financialchitchat.com. Thank you so much for watching.